Wall Street looks calm today. Indexes are not screaming, no panic headlines, no dramatic candles. And that calm is exactly why this moment matters. Because markets don't move loudly before big decisions. They move quietly first. January always starts this way. Not with chaos, but with silence. Most people misunderstand this phase. They think nothing is happening. But professionals know better. Calm markets are rarely empty. They are usually preparing. Right now, price is stable, volatility is controlled, and emotions are muted. That combination is never accidental. This is where positioning begins. Institutions don't chase excitement, they wait for clarity. And clarity often arrives in calm conditions. Retail traders usually relax here. They assume risk has faded, but risk doesn't disappear. It hides. Wall Street understands this well. They watch behavior, not headlines. They study reaction, not prediction. When markets stop reacting emotionally, something shifts. That shift is intention. January is especially important for this, because new capital enters the system. Fresh money needs structure, and structure forms in silence. This is why calm can be dangerous, not because prices fall, but because direction gets decided. Most traders look for movement. Professionals look for confirmation. Confirmation doesn't shout, it whispers. That whisper is what we're seeing now. At MarketPulseUSA by AB, we focus on reading these quiet phases, so you don't confuse calm with safety, and you don't wake up late. This calm is not weakness, it's a warning. Calm markets create a false sense of comfort. When nothing dramatic happens, attention fades. That's exactly when positioning quietly begins. Professional money does not enter during noise. It enters when emotions step aside. Right now, emotions are muted across markets. That is not random. January brings fresh allocation decisions, funds reset risk models, portfolios rebalance exposure. This process requires stability first. Stability allows assessment. Assessment leads to intent. Intent leads to action. But action does not appear immediately. It builds layer by layer. Markets often pause before they choose direction. That pause absorbs uncertainty. Uncertainty is expensive for institutions, so they wait for calm. Calm reduces error. Reduced error invites size. This is why flat price action matters. It is not boring. It is evaluative. Big money watches how price reacts to small news, not the news itself. Reaction reveals confidence. Right now, reactions are controlled. Pullbacks are shallow. Rallies are not emotional. The balance signals discipline. Discipline precedes commitment. Retail traders usually miss this. They wait for confirmation candles. By then, positioning is already done. January rewards preparation, not excitement. That's why early signals feel invisible. They don't trend on social media. They don't create urgency headlines. But they matter more than noise. Markets are teaching patience right now. Patience is uncomfortable, but it is profitable. This calm is not the end. It is the setup. At MarketPulseUSA by AB, we focus on identifying this setup clearly, so you don't mistake silence for safety, and you stay ahead of the move. Calm markets always reveal behavior before direction. Behavior is more honest than price. Right now, behavior is controlled and consistent. That combination is rare. When markets panic, behavior becomes reactive. When markets top, behavior becomes aggressive. But when markets prepare, behavior becomes quiet. Quiet does not mean inactive, it means selective. Institutions start by watching liquidity, not just availability, but reliability. Reliable liquidity means exits exist. Exits reduce fear. Reduced fear allows entry. This is how size enters markets, not through excitement, through confidence and structure. Structure forms when volatility compresses. Volatility compression is visible now. Daily ranges are narrowing. Intraday reversals are controlled. That tells professionals risk is manageable. Manageable risk attracts planning capital. Planning capital is different from trading capital. Trading capital reacts. Planning capital commits. January is dominated by planning capital. That's why price often moves sideways first. Sideways movement tests patience. Patience filters weak hands. Weak hands exit quietly. Strong hands replace them. This replacement phase feels invisible, but it is critical. Markets absorb supply during this phase. Absorption creates stability. Stability creates opportunity. Another signal appears in volume behavior. Volume is steady, not explosive. Explosive volume signals emotion. Steady volume signals intention. Intention lasts longer. That's why calm volume matters. Another sign is news reaction asymmetry. Bad news no longer creates collapse. Good news does not create euphoria. Balance dominates response. Balanced response shows maturity. Mature markets don't rush, they position. Retail traders often misread this. They expect drama. Markets offer preparation instead. At MarketPulseUSA by AB, we focus on reading preparation phases clearly, so viewers don't chase late moves and don't exit before opportunity forms. Confirmation never appears as a single moment. It forms through repeated behavior. Wall Street looks for consistency first. One signal alone is never enough. They want alignment across multiple layers. Price behavior is the first layer. Right now, price respects key levels. Breaks are shallow. Recoveries are controlled. That respect signals acceptance. The second layer is time. Markets spend time at levels. Time absorbs uncertainty. Uncertainty is supply. When supply is absorbed, pressure fades. Wall Street watches how long price holds, not how fast it moves. Holding builds confidence. The third layer is reaction speed. Sharp reactions signal emotion. Slow reactions signal thought. Thoughtful markets attract institutions. Right now, reactions are measured. Measured response indicates control. Another layer is correlation behavior. Assets are moving together calmly. No extreme divergence appears. Coherence suggests system stability. System stability allows scale. Wall Street also studies failed moves. Failed breakdowns are powerful signals. They show demand underneath, demand that does not panic. This type of demand is intentional. Another confirmation comes from pullback quality. Pullbacks are shallow, they resolve quickly. That shows buyers remain present. Presence matters more than speed. Speed attracts noise, presence attracts structure. Wall Street also monitors overnight behavior. Futures gaps are limited. That means global alignment. Alignment reduces risk models. Reduced risk allows allocation. Another signal is volatility compression. Compressed volatility precedes expansion. Expansion follows direction. Direction follows confirmation. This sequence repeats every cycle. Most people only notice expansion. Professionals prepare during compression. That's the difference. January is famous for this behavior because fresh capital demands confirmation first. Once confirmation is clear, movement accelerates. At MarketPulseUSA by AB, we focus on identifying confirmation early. So viewers, don't confuse patience with indecision. And don't miss the real move. Once confirmation is established, action does not explode. It scales quietly. Wall Street never commits all at once. They test comfort first. Initial positions are partial. Partial positions reduce emotional risk. If markets respond positively, size increases. If not, exposure pauses. This flexibility protects capital. Scaling is about intent, not speed. Speed attracts attention. Attention increases risk. Institutions prefer invisibility. They add exposure gradually. Gradual exposure avoids distortion. Another scaling behavior is time extension. Positions are held longer. Short-term flipping decreases. Longer duration signals confidence. Confidence grows from confirmation. Another sign is reduced hedging pressure. Hedges become balanced, not aggressive. Balanced hedging shows comfort. Wall Street also watches pullback response. Pullbacks are treated as opportunity, not as threat. Opportunity mindset sustains trends. Another scaling signal is bid patience. Bids wait. They don't chase. Waiting reflects trust. Trust allows size. Sector behavior also matters. Leading sectors receive steady inflows, not bursts. Consistency shows planning. Another sign is reaction to mixed news. Markets stay stable. Stability confirms maturity. Mature markets attract capital. Another scaling behavior is volume normalization. Volume becomes steady, not spiky. Steady volume supports durability. Wall Street also watches narrative silence. Less explanation appears. More execution happens. Execution matters more than words. Another sign is overnight calm. Global sessions align. Alignment reduces friction. Reduced friction allows scale. Scaling is not emotional. It is procedural. That is why most people miss it. They look for excitement. Wall Street looks for comfort. Comfort enables commitment. This phase feels boring to many, but boring is powerful. Because boredom filters impatience. Impatience exits early. Patience remains. At MarketPulseUSA by AB, we focus on recognizing this scaling phase clearly. So viewers, don't mistake quiet strength for weakness. And don't chase when the move is already mature. This is the phase most people misunderstand. Not because it is complex, but because it feels uneventful. Retail investors often lose patience here. They expect movement to validate decisions. But validation comes later. Markets do not reward impatience. They reward preparation. Quiet phases are uncomfortable because nothing feels confirmed, yet confirmation is forming underneath. Retail traders often seek excitement. Excitement usually arrives late. Late entries carry higher risk. This is where frustration begins. People assume markets are stuck. They assume opportunity is gone. In reality, opportunity is being built. Wall Street understands this cycle well. They do not react to boredom. They use it. Boredom filters emotional participants. Only disciplined capital remains. That remaining capital shapes direction. Another common mistake is overanalysis. Too many opinions create confusion. Behavior is clearer than commentary. Markets reveal intent through repetition. Repetition is visible now. Stability is visible now. Consistency is visible now. These signals do not trend on social media, but they decide outcomes. January sets tone more than any other month. Because positioning happens early. Early positioning defines advantage. Advantage compounds quietly by the time headlines turn positive. Most of the move is already underway. This is why understanding phases matters not to predict, but to prepare. Preparation removes emotional pressure. Pressure causes mistakes. Calm observation creates clarity. Clarity supports discipline. Discipline protects capital. At MarketPulseUSA by AB, this is exactly what we focus on. Helping you see what matters before it becomes obvious. Helping you stay aligned instead of reactive. Helping you understand calm strength. Markets will move again. They always do. The question is whether you are ready. If this perspective helped you think differently, stay connected. Subscribe to MarketPulseUSA by AB, because the next move always starts quietly, and those who recognize it early never need to rush. January is not about speed. It is about alignment. Markets reset expectations at the start of the year. Capital reassesses priorities. Risk models adjust quietly. This process takes time. That is why early January often feels slow. Slowness is not weakness, it is calibration. Large institutions do not rush new exposure. They test stability first. Reduced error increases confidence. Confidence invites commitment. This is why patience becomes an advantage. Most participants underestimate this phase. They expect momentum immediately, but momentum needs foundation. Foundation forms through repetition. Repetition is visible in price behavior now. Levels are respected, breaks are contained, recoveries are controlled. This tells professionals risk is understood. Understood risk is acceptable risk. Acceptable risk allows planning. Planning capital is different from trading capital. Trading capital reacts quickly. Planning capital commits slowly. January belongs to planning capital. That is why emotional traders feel uncomfortable. Nothing feels urgent. Urgency is not required. Preparation is. Another key behavior is reduced noise sensitivity. Markets stop reacting to every headline. Reaction becomes selective. Selective reaction shows maturity. Mature markets build trends quietly. Another signal appears in volume distribution. Volume spreads evenly. No sudden spikes dominate. Even distribution reflects intention. Intention lasts longer than excitement. This is why January often defines direction, not through movement, but through positioning. Those who understand this phase stop chasing clarity. They allow clarity to form. Allowing clarity is a skill, a rare one. At MarketPulseUSA by AB, we focus on developing this skill, so viewers stay aligned with structure, not distracted by noise, and ready when movement finally appears. One of the biggest differences appears in patience. Institutions operate on timelines. Retail often operates on emotion. Emotion demands speed. Institutions demand alignment. Alignment takes time. This is why January feels slow to many traders. They expect instant movement. But instant movement attracts poor positioning. Professional money avoids that. Institutions scale only when comfort increases. Comfort grows from repeated stability. Stability is visible now. Retail often interprets stability as stagnation. That interpretation creates frustration. Frustration leads to forced decisions. Forced decisions usually fail. Institutions wait for clarity to mature. Maturity does not rush. It develops quietly. Another difference appears in reaction to headlines. Retail reacts immediately. Institutions observe first. Observation reveals intent. Intent guides action. This difference matters most in January because early mistakes compound quickly. Institutions protect capital first. Retail often seeks quick validation. Validation is delayed intentionally. Markets test patience before reward. This test eliminates weak conviction. Weak conviction exits early. Strong conviction remains. Another contrast is position sizing. Retail often commits too much too fast. Institutions layer exposure gradually. Layering reduces regret. Reduced regret improves discipline. Discipline preserves opportunity. Another difference is exit behavior. Retail exits emotionally. Institutions exit strategically. Strategy outperforms emotion over time. Another contrast appears in boredom tolerance. Retail dislikes boredom. Institutions welcome it. Boredom means structure is forming. Structure supports durability. Durable trends last longer. This is why institutions thrive in quiet markets. They are comfortable waiting. Waiting filters noise. Noise distracts retail participants. Distraction leads to mistimed action. January is full of these traps. Most traders fall into them unknowingly. Those who avoid them gain advantage. At MarketPulseUSA by AB, we focus on highlighting this contrast clearly, so viewers understand patience as a strategy, not as hesitation, and stay positioned with discipline. January presents opportunity, but also traps. Most traders focus only on opportunity. They ignore the traps. This is where mistakes happen. The first trap is false confidence. A few green days feel convincing, but early strength does not guarantee continuation. Institutions wait for confirmation. Retail often celebrates too early. Another trap is overexposure. January. Excitement pushes traders to size too fast. Fast sizing increases emotional pressure. Pressure reduces decision quality. Another common trap is chasing headlines. January headlines are loud. Markets are often quiet underneath. Headlines exaggerate direction. Behavior reveals truth. Another trap is misreading pullbacks. Healthy pullbacks feel threatening to retail, but professionals see opportunity. Opportunity exists only within structure. Structure is still forming early January. Another trap is impatience with consolidation. Sideways markets frustrate traders. Frustration leads to forced trades. Forced trades usually fail. Another trap is assuming liquidity is unlimited. Liquidity varies during early sessions. Thin liquidity amplifies mistakes. Institutions respect this. Retail ignores it. Another trap is confusing volatility with trend. Volatility alone means nothing. Trend requires consistency. Consistency is not obvious yet. Another trap is emotional comparison. Seeing others profit creates urgency. Urgency destroys discipline. Another trap is ignoring failed moves. Failed breakdowns are important signals. Retail often misses them. Another trap is anchoring to last year's behavior. Markets reset every January. Old assumptions lose relevance. Another trap is assuming speed equals skill. Speed increases error probability. Skill is measured by patience. Another trap is neglecting risk management. Risk feels distant during calm periods, but calm does not remove risk. It disguises it. Another trap is overtrading boredom. Boredom is not danger, it is preparation. Those who respect boredom survive. Those who fight it lose focus. January exposes discipline quickly. Early mistakes compound. Late corrections cost more. Avoiding traps is more important than finding signals. Signals appear naturally when traps are avoided. At MarketPulseUSA by AB, we focus on helping viewers avoid these January traps, so they stay aligned when others rush, and protect capital while opportunity builds. Everything we discussed comes down to awareness. Markets are not silent by accident. Silence is part of the process. Wall Street does not rush decisions. It prepares quietly. January exposes this behavior clearly, because fresh capital demands structure first. Structure forms before movement. Movement only follows when alignment is complete. Most people wait for price to move. Professionals wait for behavior to settle. Settled behavior reduces risk. Reduced risk invites commitment. This is why calm markets matter. They reveal who is prepared and who is impatient. Impatience always pays a higher price. Preparation pays quietly. The biggest mistake is ignoring this phase, because it feels unimportant. But this phase decides positioning. Positioning decides outcome. Outcomes are not random. They are earned through discipline. Markets reward those who observe calmly, not those who chase emotion. January is not about prediction. It is about preparation. Preparation removes pressure. Pressure causes mistakes. Mistakes compound early. Discipline compounds quietly. This is why smart money looks boring. Boring is efficient. Efficient behavior survives volatility. Volatility always returns. Those prepared remain steady. Those unprepared react emotionally. Reaction always comes late. Late action increases regret. Understanding phases removes regret. Phases repeat every cycle. Only participants change. Those who learn early stay ahead. Those who ignore calm phases repeat mistakes. Markets will move again. They always do. But the real question is readiness. Readiness forms now, not later. At Market Pulse USA by AB, this is exactly why we exist. To help you recognize what matters before headlines appear. To help you stay aligned instead of reactive. To help you prepare instead of chase. If this series helped you see markets differently, stay connected. Subscribe to Market Pulse USA by AB, because the next move always begins quietly, and those who understand calm never need to rush.